Hey everyone, and welcome back to today's Explainer. It is August 21st, 2026, and today we're setting the stage for a really critical deep dive into the polymer market. Right now, the global PVC bazaar is giving us some strong hints of an upward structural pivot. And look, if you're procuring, selling, or analyzing in this space, you probably feel it. The ground is literally moving beneath your feet. So we're going to unpack exactly what is happening in this midweek global intelligence report.
Okay, let's dive right into this. Here is our roadmap for today. We're kicking things off with the PVC pricing paradox. Then we'll reveal the hidden global market drivers, give you a regional pricing breakdown, analyze India's monsoon demand shift, figure out how to navigate Q3 volatility, and wrap up with how to stay ahead with Polymer Bazaar.
All right, Section 1, the PVC pricing paradox, rising prices amidst weak demand.
I know a lot of you are out there scratching your heads right now. You look at your downstream sales, and honestly, the math just doesn't match the current market sentiment. Which brings us to this core mystery. Why on earth are PVC prices rising when global demand is, frankly, pretty weak? Usually, weak demand acts like a ceiling. It caps any sort of aggressive bullish momentum. And yet, we're seeing the market push upward anyway. To make sense of this paradox, we've got to look past the surface-level demand metrics and really peer under the hood of the supply chain.
Moving on to Section 2, hidden global market drivers. The forces squeezing the market. To really understand this squeeze, we need to look at the structural forces actively pushing prices up, forces that are completely defying standard demand logic right now. There are four primary drivers shaping the global PVC bazaar today. First, shifting pricing dynamics. Second, severe pressures on producer economics. Third, unexpected supply constraints. And fourth, some absolutely massive spikes in freight overhead. When you combine these four elements together, the upward price correction we're experiencing suddenly makes perfect sense.
Let's zero in on that freight overhead for a second, because it's a big one. Get this, in August alone, we saw a staggering 50% jump in Asia to India ocean freight rates. I mean, wow, this massive spike in logistics costs is a huge structural driver. You just cannot absorb a 50% freight hike without it directly lifting CFR landed values. It's a mathematical certainty, and it's instantly reshaping spot offers across the board.
Furthermore, let's talk about producer economics. Asian carbide margins have absolutely tanked, falling to a 5-year low. Meanwhile, ethylene-based producers globally are getting squeezed incredibly hard by elevated ethylene costs and just super high energy overheads. Basically, producers have been backed into an unsustainable corner. They're bleeding margin and simply cannot afford to maintain the previous price floor.
And, as if that margin compression wasn't enough, we are now dealing with severe supply constraints. We're seeing incredibly low operating rates across both China and India right now as producers are forced to scale back. On top of that, you've got Formosa, Taiwan's recent unexpected outage combined with ongoing Chinese inventory draws. This is severely restricting the available spot supply in the bazaar. So, less supply plus higher production and shipping costs, it equals a forced price hike.
Okay, Section 3, regional pricing breakdown, global numbers at a glance.
Let's move to the hard data and see how this builds out globally. Walking through these specific numbers, China carbide PVC is currently sitting between $690 and $710 per metric ton. That's largely due to those squeezed 5-year low margins we just talked about, plus a recent $50 per ton bump driven by Indian export demand. Meanwhile, China C2 PVC is tracking slightly higher at $710 to $720, pushed up by those low plant run rates. Over in the West, US FAS PVC is at $690 to $710. That's rebounding from recent lows around $570, heavily pressured by those high energy costs. And finally, EU suspension-grade PVC is holding steady between $790 and $810.
And this brilliantly illustrates the dynamic at play. When you chart the upper bounds of these major hubs, the contrast is super stark. While China C2 sits at $720 and US FAS is at $710, look at the distinct premium the European market still commands at $810. Although, it is definitely worth noting that Europe has eased quite a bit from its massive peak of around $1,250 per metric ton back in early 2026.
Next up, Section 4, India's monsoon demand shift, navigating the local context.
To make sense of the broader Asian pricing dynamics, we actually have to zoom in on a massive catalyst, and that's India. Typically, during the monsoon season in India, we expect a very clear pattern, a heavy demand slowdown because construction and related industries just come to a complete halt. But that's not what we're seeing today. Contrast that typical seasonal expectation with the current market, where demand is surprisingly moderate. It just hasn't plummeted the way historical models would suggest. And this moderate Indian demand, it's created a global ripple effect. It's the direct reason why Chinese FOB carbide PVC prices have actually strengthened by $50 per ton recently. That consistent pull from India, paired with firming feedstock costs back in China, really shows exactly how interconnected these regional bazaars actually are.
All right, Section 5, Navigating Q3 Volatility, the editorial verdict. With all these moving parts, we need to look ahead to Q4. So, the crucial point to remember is this. The current uptick in PVC pricing represents a cost-push necessity rather than a demand-driven economic surge. Producers have literally reached an unsustainable margin floor. Their only options to stay afloat are to either maintain low operational rates or raise prices. This isn't some global economic boom, folks. This is survival mode for producers.
Because it's a cost-push market, you really need to prepare for what comes next. Supply tightness and cost pressures absolutely support a further $30 to $40 per ton upward correction in Asian C2 PVC quotes in the near term. Now, this offers producers some brief margin relief for sure. However, and this is a big however, without a genuine recovery in global construction and downstream demand, these higher price levels are absolutely going to face fierce buyer resistance. Bottom line, the bazaar is going to remain highly volatile.
Finally, Section 6, Stay Ahead with Polymer Bazaar, your strategic advantage.
Look, navigating a volatile cost-push market like this is incredibly challenging. So let's talk about how you can gain a strategic advantage in this tough environment. If you're an importer, this is a massive opportunity for you. We are thrilled to invite you to join our upcoming Polymer Bazaar delegation to Taiwan for Taipei Plus. It's happening from September 15th to the 19th. This is your chance to meet directly face-to-face with Formosa and other major polymer producers. And get this, we're even offering free accommodation and other amazing perks for those who join us.
Now, what's really interesting here is just how fast you can get updates. You don't have to wait for weekly reports to make daily decisions anymore. You can just use our AI-powered chatbot for instant news. It is so easy. Step 1, just WhatsApp the letters PVC to +91 9374 624 365. Step 2, you'll get a highly accurate market reply in less than 5 seconds. It's a total game changer for fast-paced trading.
And of course, if you are looking to actively buy, sell, or import PVC, our dedicated relationship manager is available directly at +91 95108 24365. You can also visit us online at www.polymerbazaar.com or reach out to our general line at +91 9375 424 365. Hey, and don't forget to like, share, and subscribe to this explainer and hit that bell icon so you never miss these fresh, critical market alerts.
Before we wrap up, I want to leave you with a critical question to chew on. As we've seen today, the market is being pushed up by costs, not pulled by demand. So, without a genuine recovery in downstream demand, how will you adapt your procurement strategy to survive this late Q3 cost-push volatility? The market is shifting. Make sure your strategy shifts with it. Thanks so much for joining me on this explainer, and we'll see you next time with more crucial bazaar intelligence.